Welcome back, options traders. Jake here. Currently on my Schwab account, I have a very complicated options position set up on Apple. So in this video, let's break it down step by step how I got into it and what I hope to get out of it. And I'm calling this option setup a risk-free debit spread, and I think this is very confusing to people because how can it be risk-free? There's always risk inherence with every trade, especially options, correct? Well, no, I found a way around it, so let's explain exactly how this came about. And you'll see that I first opened this position by buying 3 calls on Apple, and I did this back on November 3rd. On November 3rd, Apple's share price was $149. So when I purchased these 3 call contracts on Apple, the share price was $149, and I chose a strike just out of the money. That's personally where I like buying my call options. So the strike was $150, and the premium I paid, the cost per share, was $18.66 per share, or $1,866 per contract. I have quantity 3 contracts, for a cost basis of $5,596. The expiration date for these contracts are January 2023. I personally like contracts that are far out in the future so that I can give it plenty of time to recover should an unexpected market sell-off occur. So for fun, my break-even price on these contracts is $168.66. To determine that, you add your cost per share to the strike. So basically, I'm not making any money on these contracts. I'm not overcoming the cost I'm paying on them until Apple is above $168.66. And good news, here we are 3 months later, and I sold 3 calls against these calls that I bought on February 4th. So Apple's current share price is $172.39. We'll just say 172. And I want you to notice that the call contracts that I bought 3 months ago appreciated in value. So what is the current price to buy or sell, to buy to open or sell to close? And it's saying $34.22.5 or $3,422 or $23. That is an 83% increase on what I paid for these contracts. So if you want to just make things simple, you can always sell to close your contract to somebody else, and you can net the profits. Cost basis $5,500. The current value of these 3 is $10,266. But let's break it down here and try and understand what is this premium, where is the value coming from? So the value per contract, $3,422, it's composed of intrinsic value and extrinsic value. The intrinsic value is just the difference between the current share price, 172, and the strike, 150, when the share price is above the strike on the call side. So this premium of $3,422 per contract, it's only $2,239 in intrinsic value, the difference of the share price from the strike, which is why you would never exercise an option contract early. You're giving up what is remaining, and what is remaining is extrinsic value. This is how options prices are determined. Extrinsic value is made up of volatility and time, and every day, slowly towards January 2023, theta decay is eating away a couple dollars or whatever, the remaining extrinsic value on these contracts. So I now have 3 calls that are deep in the money. You can think of them as leaps if you're familiar with what leaps are. But I had to wait for share price movement to basically accumulate this market value close to basically what I put in. So that brings us to today, February 4th, where I sold. I'm selling calls now, which gives me a quantity of -3, and I did a strike just out of the money, so 175. And the premium that I'm being paid, I am now the seller, sell to open. Somebody is paying me the $20.14 per contract, or 2014 total cost basis to the person paying me is $6,042. This is money that went into my account today. However, as the seller, I now have an obligation to buy 100 shares of Apple at the strike per contract at expiration if it's beneficial to the buyer. So I'm now the buyer and the seller of Apple for 3 combined contracts. What I've done here is I've constructed a debit spread. Let's go through the stats real quick. Break even is 195.14. Once again, just add your cost per share to the strike of 175. Let's pretend I owned 300 shares of Apple and I sold 3 covered calls with a strike of 175. As the person who has the 300 shares, I'm not losing value as long as Apple stays below 195.14. So you have to remember, I sold these contracts and they're out of the money. How much of this premium that I was paid of $6,042 is intrinsic value, and it's 0. The share price has to get above the strike for the contracts to start accumulating intrinsic value. So the rest is extrinsic value, volatility and time, theta decay. So let's pretend that Apple stays below 175 for the rest of the year, going all the way to January 2023. And the share price stays perfectly at 172. What would happen to these contracts, the cost basis, it would go to 0. The contracts would expire worthless, out of the money. My contracts would basically also go down, but they would go down to what the intrinsic value amount I gave you is. So how is this a risk-free debit spread? And it's risk-free for me now because I paid $5,596 to purchase these 3 with a strike of 150. Somebody then paid me $6,042 for a strike of 175. So I've basically cashed out of this position from my original investment of $5,596. So let's talk about the 2 extreme positions that can happen with these 6 contracts. And the first one is, by expiration, Apple falls below 150. If Apple falls below 150 by January 2023, I just want to quick say I never hold contracts until expiration. I don't plan to. I'm just giving you the theory here. If I held all these till expiration and Apple was at 149, then all of these contracts go to 0, they expire worthless. That's unfortunate for me considering the market value is $10,267. So the market value of this, how much I would have to pay back to close, would go to 0. How much I could sell to close also goes to 0. So yes, I would net lose about $5,000 if Apple's share price just tanked, but I can't lose my initial investment anymore. So let's go to the other extreme and pretend that Apple goes way above 175 by expiration. So once again, if I held these contracts until expiration, the calls with the lower strike are my collateral. I don't own 300 shares. I never will own 300 shares. But when all of these trigger at expiration at the same time, my broker knows that I'm paying somebody $150 per share, $150 times 100 per contract. I'm then going to sell it to somebody else, those exact same shares, instantaneously. I'm buying for $150, I'm selling to somebody else for $175. I then get to net that profit, and that profit is $25 in share price difference, multiplied by 100 shares per contract, multiplied by 3 contracts. So my max profit from where I currently am is $7,500. In addition to, you can think about it, pulling out this $6,000 today. But this position that I'm in, I only plan on it being temporary. The reason why is I've looked at the technicals. I'm thinking forward to the volatility we might see in February and March, and my belief is that over the next month or two, Apple's share price will sell off and go back to 160. It's not going to free fall or collapse or get below 150, I think, but by selling calls against my calls in the money, I can make profits. I can gain some value if Apple's share price does pull back. So let's pretend at a future date in a month or two, Apple's share price pulls back to 160. So the calls that I bought are losing value. Oh no. But the calls that I sold are also losing value, meaning that it's cheaper to buy them back in order to exit that position. And that's exactly what I would do. These calls that are in the money at 150, I'm holding those no matter what. But the calls that I sold, I'm going to buy to close once the market value falls. Maybe it'll fall to $3,000. So somebody paid me $6,000 when I sold to open. I'm then going to buy them back to, -3 plus 3 cancels out, hopefully for a market value of maybe $3,000. And then I just made $3,000. Pretty cool, right? And of course, my long-term thesis here is that Apple will just drift back up, going back to 170 or 180. At this point, I don't have any calls sold against my calls that are now gaining back value. It's going to go back up to a market value of about 10,000 if Apple just drifts back up. And when Apple drifts back up, what do you think is going to happen? I'm going to be watching the technicals, making sure that Apple's not due for a breakout. If it pulls back, or I think it's going to pull back, once again, I'm going to sell calls against my calls that are deep in the money, keep trying to net premium in the short term. And I'm just going to repeat this process probably a couple times over the next 10 months or so. So there you have it, guys. That is why I am calling this a risk-free debit spread. I've protected my downside by pulling out my initial investment should the entire market collapse and never recover. And I am capping my upside if Apple just takes off, goes to 180, 190, or 200 and never comes back down before January. But I'm okay with that if the max profit from this point is only an additional 7,500. I'm going to keep making these kinds of trades, so hopefully you can follow along when I do this with future positions. If you guys enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, let me know down below. I'll help you if I can. Till the next video, take care.